Thanks for tuning in. You're watching Markets Tomorrow. I'm Nikunj Dalmia.
Hi everyone, I'm Avan. The Bash is a fairly volatile expiry day.
Yes, indeed, Avan. Let's take a look at Indian markets and how things really shut shop for Indian markets for the day gone by. Nifty was volatile on expected lines on the expiry day. We saw a lot of back and forth volatility. Having said that, Nifty has appreciated by about 3.1% in the month of December. OMC stocks were up on buzz of a diesel price hike. Two-wheeler stocks, they corrected. Both Bajaj Auto and Hero MotoCorp were down, but they corrected on low volumes, which means they could pick up. There was a marginal underperformance by India today, as we did manage to underperform both Hong Kong, Korea, and also Japan by some extent. Axis Bank was the big story. It appreciated after there was an increase in FI limit. Bajaj Auto came down as brokerages in general are of the view that they could lose more market share going forward. Let me just nail it down to the absolute gainers and losers. You've got Tata Power, ONGC and BPCL. Nifty losers, they include names like Hero MotoCorp, Lupin, Ranbaxy. Stocks at a 52-week hand. This is an ever-expanding list, and that just tells you the bent of the market. Escort, Sonata, Calcutta Electric, SL Propack, Arvind Mill, Aurobindo Pharma. It's a long list, Avan, but that's the story, that the 52-week high list is a very expanding list.
Let's get in our experts and find out what they made of the market momentum today. Manishi Ray Chaudhary now joins in on the show to give us his views on the markets. Manishi, to start off with, for the month of December itself, it's been rather rewarding, but some would argue that it's history now. January could be a completely different kettle of fish as we would be pitted against the global macro earnings as well.
You're right. And, I think there are different kind of drivers that we would look forward to in January. First of all, the global macro that you mentioned. I mean, one of those data points are behind us. That's the scare of taper. In fact, I personally think it's a good development that the Fed has decided to initiate the process, because then it means that that's one uncertainty that's behind us. The next set of important data points would constitute the result season that's coming up, and I think we may actually end up with some small earnings downgrades during this season and possibly the next one. So in effect, I would think that this sort of flattish consolidation phase that the market has entered into may continue for some more time.
Because markets have done nothing special this week, and that is on expected lines, because books are clearly shut for most of the global guys, and it's shuttered down when it comes to some of the large long-only funds. But what deserves a special mention is the December series, because even though we saw that big index, that big election adjustment for the market, the index has done nothing. But for the first time after a gap of many months, IT and high beta along with cyclicals, they moved in a synchronized manner. So if I look at the December series, one end we had IT, which appreciated by about 7% plus. On the other hand, we had the real estate index, which appreciated by about 9 months. And that, to my mind, is the key differentiator in the December series. In this entire year 2013, we've seen a rally, a risk on or a risk off rally. So if IT has gone up, defensives. If IT has gone up, banks have come down. And if banks have gone up, IT has come down. But for the first time, that has changed. B, small cap stocks have rediscovered momentum. So maybe the market message is that now market is in a mood to really revisit mid and small cap stocks. And the fact that non-institutional stocks are doing okay, that just tells you the polarized nature of the market is changing. That, to my mind, is the big market message which you can really derive from the December series, that the small cap stock or the mid-cap stocks are making a comeback.
That was certainly evident in today's session. But Ashwini, run us through what your expectation is now from the January series. Ashwini?
The expectation is that we are in a fairly...
Go ahead.
Yeah, can you hear me?
Right, go ahead, Ashwini.
See, the point is that we are going through a fairly weak rally, extremely choppy. The very second day of the rally, we couldn't get follow through. So let's be clear that this is a fairly weak rally. Now we can hang on to, 6200 is holding on, but 6250 is holding on. The point is momentum is extremely low. There is lack of broad leadership, particularly from banking space. So the way next series could pan out is that post whatever upside is there, once that's over, and that may not be more than 100 points, we should see a decline which will break 6150 and maybe again around 5900, 5950, the market will have enough shorts and will be able to build enough momentum for the next serious leg of upside. This market in its current shape and form and momentum, I don't think has too much of upside, and slowly, once this range cannot be broken, or even if it's broken, the very next day, what you'll see is the market tending to collapse. So people have to be careful, and all long positions have to have a stop of about 62.40. And if we are not able to make headway, I think by first week of Jan, that downside will start coming in.
Actually, the big departure in the December series has been the price action in mid and small cap stocks. How should one read into the price action in small and mid cap stocks? Is that some kind of an early indication that the polarized nature of the market is changing? Or if the tail really starts wagging, that is some kind of an indication that markets are about to peak out?
Well, the point is that flows have dried up. And, if you go on the street, the sentiment is pretty good about the elections. People are finally beginning to feel much better that maybe NDA is coming back, etc. So as long as 6,000 is maintained, you will see mid caps, small caps flying around. It's too early to say that, the rally is ending, because mid caps, small caps, a 400 rupee stock is at 40 bucks. From 40, it goes up to 80. You can't say it's topping out. But clearly the kind of activity and some sort of money flow is now getting attracted to mid cap and small cap, and that could be your best bet for the next 3 to 4 months, because it looks very unlikely that the index is going to break 6400 with any kind of hurry. You will get upswings, sometimes there'll be large upswings of 500-600 points, at other times there'll be 300 points like the one we've just seen. But overall, the next 4 months is going to be about mid caps, and a lot of catch up will happen, because as we get into the election, chances are that mid caps will also be around their 2-3 year highs.
Let's also get in Nitin Raheja, CIO at AQF Advisors, who now joins in live on the show. And, Nitin, let's just dwell on that point that Ashwini brought up, that this is now going to be the time for the broader markets to really outshine. And do you think that now, with the way it's performed in this series for the broader markets, it's time for that basket to really bask in the limelight?
Well, actually, this has been happening for some time now. While throughout the year, you've been getting this so-called risk-off, risk-on happening, people getting scared of the taper and so on and so forth. If you actually see, the broader market has done quite well. You've seen individual stocks have had a fair run-up, and segments of the market doing extremely well. So I think you will probably continue that trend. Actually, there will be two kinds of stories playing on from time to time. At one level, you will have the broader market and single stocks or bottom-up ideas continue to perform well. At the other end, you will get these moods of positivity coming on the basis of in the run-up to the election, where suddenly you'll see all these so-called infra and the capital goods names and the so-called economic sensitives suddenly having a rally in the middle and then again correcting and so on and so forth. So I think you're going to get a mix of both these in the next couple of months.
Nitin, wanted to get in your perspective on a select basket of stocks that has done fairly well for itself, and that would also have to be the way metal stocks have performed. Given that some would argue that fundamentals haven't really changed when it comes to this sector, what are your views?
Well, in our portfolio, at least, I can say that we are staying away from these metal counters because there's they're really pure value plays from a perspective, which has always been the case. At the bottom of the cycle, metal stocks will always, find that kind of interest. But clearly, till the economy is not back to its high growth rates, you can play this as a trading punt, but we believe there are lots of other stocks and sectors out there with far more visibility, and far more better balance sheets to play out as such.
Ashwini, we saw a rub of red for large cap pharma stocks today. Ranbaxy and Lupin. How would you characterize that price action? Routine profit booking? Time to revisit pharma? Okay. Ashwini, that question was for you and it was on large cap pharma.
Yeah, what's the question?
We saw a rub of red for large cap pharma. In the overall scheme of things, is that important?
See, today was expiry, and generally it's not a wise idea to take the expiry up and down quite seriously. But if you have to choose across the spectrum, I think IT and pharma continue to remain stronger of the stocks that are otherwise there in terms of rate sensitives and defensives. Today we saw Dabur, ITC doing well. So it appears that the market is getting more and more defensive as it gets into the next year, and the banks, etc., other than sporadic moves, are kind of dropping off. So I think on pharma, if you are getting dips on Oro Pharma, Biocon, even Sun and Lupin, they are fairly decent buys from here because they are not dependent to that extent on the election.
Manishi, what's the call on some of the NBFCs which are outperforming financials and standalone banks? Is there more upside here?
Yeah, difficult to guess because, I think in an environment of relatively tight liquidity, which I would think would, perhaps continue for some more time, the NBFCs which are predominantly wholesale funded should possibly face a slightly higher degree of pressure on the net interest margins than the banks. So logically, I would not have expected this relative trade that seems to be happening right now. Having said that, the Indian market is always, it's an agglomeration of stocks. So there are stock-specific reasons which might be at play. And I think for some of these NBFCs, there is some degree of hope about industrial revival, that seems to be getting built in. Though, I don't know whether the market is kind of jumping the gun on that count.
Nitin, jumping on NBFCs, banks or standalone banks are not doing all that well, but NBFCs across the board are moving from strength to strength, be it Grow Finance or M&M Financial. I can throw in a Diwan Housing Finance, talk about Bajaj Finance, but that group is on a tear.
Sure. So, I think I kind of agree with what Manishi said some time ago, that I think you are seeing extreme strength happening there, and I think it could be a case where, and among them also, there seems to be a big segregation of quality Nikunj. So you have a Mahindra & Mahindra Finance on one hand, which is now trading at, I think, all-time high historic valuations, almost getting close to what some of the private sector banks trade on in terms of books. On the other hand, you have NBFCs such as let's say Magma, which is a second-tier NBFC, which is trading at close to its low. So you're having a great amount of segmentation, but clearly I think at this point of time, some of these NBFCs, in our view, are fully valued, and there is a lot of exuberance which is built into the price.
Ashwini, give us a chart check on what you would do with some of the names like Core Education, Evron or Educom.
Well, ignore them. They are, penny stocks now. I don't think any serious investor should be looking at stocks which fall 95%. And there is no hope of recovery other than, 10, 15, 20% move on a 20 rupee stock. I don't think you should be looking at these stocks.
Identifying some of the top stocks to keep on your radar. Ajay Sharma is standing by from our research team to tell us what exactly the dealing rooms are talking about. Ajay.
Well, Aban Offshore clearly is one stock which dealing rooms are quite eagerly talking about. The stock was slightly on the weaker side in today's session, but positional traders are getting in this stock. A lot of buzz on the street that they may be considering a QIP. They're also actively mulling how to change their high debt cost structure into a lower debt cost structure. They have 12,000 crore of debt on their books, and this kind of a development would actually save their interest costs and hence will enhance earnings. So a lot of positional traders are getting into Aban Offshore. Apart from that, Tata Global is another FMCG stock to watch out for. we understand that not only a lot of HNIs, but some funds are trading down on the valuation curve and coming out of ITC and HUL and are in fact going into mid-tier companies like Tata Global, and the stock was gaining in 2.5%. Volumes have also risen quite smartly past a couple of trading sessions. So dealers are bullish on the medium term as far as this one is concerned.
But Ajay, thanks a lot for that. The only problem for Tata Global is that they are not growing, numbers are not expanding, margins are contracting, they are expanding, and since they're expanding for the moment, cash flows for Tata Global Beverages are really are would be poor. That in a sense is negative news if you are a medium-term market watcher. Nitin Raija, how do you propose to allocate capital for 2014, and what are your top 3 non-Nifty 50 ideas?
Well, I mean, we continue to believe in the bottom-up story, and I think focus essentially on stocks where we think the growth value equation plays out beautifully. A couple of ideas that we say is like if you take something in the mid-cap space, we like a company called CARE, which we've talked about earlier, second largest rating company in India. I think if you want to play the economy and an uptick in the economy, I mean that's one of the best ways to play that. Pays out a hefty dividend every quarter. We like something like a company called Treehouse Education. I think it's in a very, very sweet space. Unlike some of the other names that you talk about, it's in the pre-schooling segment and is a market leader out there. Runs a own model of owning the schools rather than franchising them. It's also moved into the K-12 segment, growing at 35-40%. Next couple of years is going to see the high base of maturing schools resulting in high return ratios starting to show up for the company as such. And on the third, sorry.
Right, go ahead.
I'm sorry, you were saying something. Yeah. And a third idea that we think is interesting is a story like on the media side, which is like Hindustan Media Ventures, which is the Hindi part of the Hindustan Times. The stock last couple of quarters you've seen earnings numbers starting to grow and come back. I think you're moving into the election year where typically ad and media spends go up, especially when you'll see a lot of that impact on the Hindi belt. So valuations trading at about 8 times and so on and so forth on a trailing 12-month basis.
Ashwini, run us through your top picks.
Well, CSC is a buy with a stop of 435, target of 458. Siemens is a buy with a stop of 670, target of 695. And Kotak Mahindra Bank is a buy with a stop of 720, target of 745.
Manishi, let's wrap it up with your number 1 idea for 2014.
I would say that, in the Indian context, there are 2 things in the economy which are working right now.